Annika Kimiraya. Okay, so they had a pretty slow second quarter. Maybe it should have been expected. Minus 22% sales growth. It's down over 40% from the first quarter. Obviously, weak environment for fuel, and the fuel itself, the petroleum, is down 23% year on year. This is what it looks like. Sales back down to 2016 levels, but we see sales rebounding again, although it's still a small negative, minus 2.3% next 12 months. Cash flow is quite a good story, because the last 12 months, they've had negative cash flow. This is taking out the working capital since the beginning of last year, but it is coming back up again, and the last 2 quarters have been increasingly positive. So we see the cash flows, and despite the fact that sales this week, cash flow is coming back, and we're looking at 737 billion free cash flow, excluding working capital, over the next 12 months. So they've had this big decline. Now it's coming back to positive, we believe. So in the balance sheet, the negative cash flow recently, and also paying out quite big dividends, has pushed the net debt up quite a lot, 3.7 trillion. Obviously the stock doesn't like that, but with our cash flow forecast, and assuming they don't pay any dividend, then we'd be back below 3 trillion in 12 months' time. In profit, the profit actually higher from a year ago, and not exactly sure why that is, but the cash cost ratio we have has improved from 95 to 92%, but we'll treat that as a one-off. So we're using 95% to forecast that the net profit will be up about 4% to 829 billion, very similar with the cash flow. So this is the cash flow, assuming same investment spending as the first quarter. 1.6% valuation, 45% discount because the debt has become quite big, and that gives quite a big upside target to almost 6,400, back above the moving average, which would look like this. So big rebound coming here on improved cash flow.